They smashed it. Banks dumped silver at $83. Sell the news. It was a trap. January 7th, 2026. Silver rockets to $82.75. Retail investors flood in, chasing Bank of America's $300 forecast. Then the hammer drops. Price collapses to $78.54. 3% gone in hours. Millions transferred. From those who believed the headline to those who wrote it. This was not market movement. This was mechanical extraction. A textbook wealth transfer event, disguised as breaking news. The question every business leader must now answer. Were they buying an opportunity? Or were they the liquidity? Welcome to Currency Forensics, the place where we examine the mechanics, not the theatrics, of modern markets. Now, a small request for those of you who have seen a few decades pass by. You know, the ones who remember when a handshake meant something, when agreements were written in ledgers, not algorithms. If this type of analysis, this level of depth, reminds you of the serious financial commentary that once existed before everything became noise and entertainment, would you consider subscribing? Just press that button below, the same way you used to circle stocks in the Sunday paper. And while you're at it, tell us in the comments, where in the world are you watching this from? Are you in New York, London, Singapore, Karachi? Because understanding global markets requires a global perspective. Now, let us dissect what actually happened on January 7th and why every entrepreneur, every business strategist needs to understand this playbook. The morning of January 7th began like any other trading day, but within hours, it would reveal one of the most precise examples of institutional market manipulation the silver market had witnessed in years. At 8:30 a.m. Eastern Time, headlines exploded across financial terminals worldwide. Bank of America Global Research had released a report. Silver could reach $309 per ounce. Not eventually, not in some distant future. But in this cycle, retail investors, the small traders, the enthusiastic newcomers to commodity markets, saw these headlines on their phones. They saw the Bank of America logo, one of the largest financial institutions on earth, and they made a decision. They would buy silver immediately. By 9:30 a.m., the price began to climb, $79, $80, $81. The momentum built with each passing minute. Trading platforms registered unusually high retail order flow, small buy orders flooding in from individual accounts across the world. These were not institutional blocks. These were personal trades. People allocating $5,000, $10,000, $20,000, convinced they were getting in before the massive run to $300. At 10:42 a.m., silver touched $82.75. The highest point of the day. Social media erupted with celebration. We told you silver was going to the moon. Bank of America finally admits what we knew all along. This is just the beginning of the breakout. The euphoria was genuine. The excitement was real. But so was the trap. Because at that exact moment, when excitement reached its absolute peak, when retail buying pressure was at its strongest, when millions of small investors were hitting the buy button simultaneously, something else was happening. Large institutional orders, massive sell orders, began executing. Not gradually, not cautiously, but in coordinated waves. The price stopped climbing at 10:43 a.m. For 60 seconds, it held at $82.75. Then it began to fall, $82, $81.50, $81. The descent accelerated. By 11:15 a.m., silver had crashed through $80. By noon, it was trading at $79. By 2 p.m., $78.54. A 3% decline in less than 4 hours. Anyone who bought at the morning high at $82.75 was now sitting on a 5% loss in a single afternoon. But here is what makes this event a perfect case study in market mechanics. The crash was not random. It was not panic. It was not unexpected news. It was engineered precision. Consider the problem from an institutional perspective. A large hedge fund, a major bank trading desk, a commodity-focused investment firm. They had accumulated millions of ounces of silver over previous months. Perhaps they bought at $60, perhaps at $65. Now the price sat at $80. They had tremendous unrealized profit. But they faced a fundamental problem that every large trader understands. Size. When an institution holds millions of ounces, they cannot simply press sell and walk away. The market cannot absorb that volume without collapsing. If they dumped their entire position at once, the price would crater before they could exit. They would destroy their own profit attempting to realize it. So they needed something specific. They needed buyers. Not just a few buyers. They needed millions of buyers. They needed an army of retail investors to step up and absorb their selling pressure. They needed liquidity. And then, as if on schedule, Bank of America released their report, silver to $309. The headline spread like electricity through financial media. Bloomberg picked it up. Reuters ran it. CNBC discussed it. Twitter amplified it. And retail investors reading these headlines did exactly what liquidity providers needed them to do. They bought. They bought aggressively, enthusiastically, urgently. They created a wall of buy orders at $82, and the institutions, watching this unfold on their trading screens, said thank you. They sold into that buying pressure. They used retail enthusiasm to absorb institutional distribution. They converted unrealized paper profits into realized cash by transferring their position to those who arrived late. This is not conspiracy. This is mechanics. This is not theory. This is documented market structure. This is how large players exit large positions, by creating the exact conditions that allow them to sell without crashing the price during their exit. The retail investors thought they were buying opportunity. They were actually providing exit liquidity. And by 2 p.m., when the price sat at $78.54, the wealth transfer was complete. The institutions had exited. The retail investors were holding. And the lesson, for anyone watching, was brutally clear. In modern markets, timing is not about being right. It is about understanding who needs what and when. For those who study market history, certain institutions carry reputations that span decades. Bank of America, in the precious metals community, carried a very specific reputation. They were not known as silver advocates. They were known as silver suppressors for years, perhaps longer than most retail investors had even been trading. Bank of America held one of the largest derivative short positions in the silver market. The numbers were staggering, hundreds of millions of ounces, represented in paper contracts, designed to profit when silver fell. Traders in the precious metal space had a nickname for them, the Death Star, not because of science fiction, but because of function. Every time silver attempted to break higher, every time momentum built, every time small investors thought a rally was beginning, Bank of America's trading desk would appear on the other side, selling, suppressing, capping the price. They told their institutional clients that silver was overvalued, that it was merely an industrial byproduct with limited monetary value, that gold was the only precious metal worth serious allocation. Their research reports for years painted silver as a speculative distraction. So when Bank of America released a report on January 6th, the day before the crash, stating that silver could reach $309 per ounce, something fundamental had shifted. This was not a minor analyst changing an opinion. This was the Death Star, reversing its laser and firing in the opposite direction. The report was authored by Michael Widmer, their lead commodity strategist, not a fringe voice, not a junior analyst, but someone who speaks directly to the largest money managers on Earth. And in this report, he made 3 admissions that contradicted years of Bank of America's previous positioning. The first admission, supply is inelastic. For years, the standard banking response to rising silver prices was simple. Higher prices will bring more supply. Miners will increase production. The shortage will solve itself. But Widmer's report acknowledged something different. Even if prices rise dramatically, mine supply will remain flat or declining for years. The shortage is not temporary. It is structural. New mines take 7 to 10 years to develop. Existing mines are depleting. And no amount of price increase can conjure silver from the ground instantly. This admission destroyed the traditional bear case. The second admission, solar demand is irreversible. For years, banks argued that engineers would find substitutes for silver in solar panels, that copper or aluminum or some future material would replace silver's conductivity requirements. The Bank of America report abandoned this argument entirely. It projected that the green energy transition, the solar panel manufacturing surge, would consume silver faster than global mining could produce it. They validated what small investors had been arguing for months, that industrial demand alone, separate from any monetary premium, was creating a deficit. The third admission, the monetary premium exists. This was perhaps the most significant reversal. For decades, major banks treated silver as an industrial commodity only. They dismissed its monetary history. They ignored its relationship to gold. They refused to acknowledge its role as a wealth preservation asset. But Widmer's report directly linked silver's price trajectory to gold's performance. It stated that as gold breaks toward $4,500, silver must follow to maintain historical ratios. They admitted, publicly, in a research note distributed to institutional clients, that silver functions as money. This was not a small shift in perspective. This was complete capitulation. Now, the critical question that every strategic thinker must ask, why would Bank of America release this report at this exact moment, with this exact timing, if they held massive short positions that profit when silver falls? Why would they publish research encouraging investors to buy? The only logical explanation, the only scenario that makes strategic sense, is that they are no longer short. Consider the timeline carefully. In late December, during what traders call Ghost Week, when liquidity is thin and volume is low, silver experienced extreme volatility. It spiked to 83.71, then crashed violently. This type of volatility, in low liquidity conditions, creates the perfect environment for large players to cover positions, to exit short contracts, to reverse their exposure without drawing attention. If Bank of America spent December quietly covering their short position, buying back contracts, closing out their bearish exposure, then by early January, they would no longer profit from silver falling. They would profit from silver rising. And suddenly, releasing a bullish $300 price target makes perfect strategic sense. They have switched sides. They went from suppressor to promoter, from bear to bull. And now, with their position reversed, they want prices to rise. This explains the violence of the report's release. This explains the coordination with retail buying pressure. This explains why the price was allowed to spike before being sold down. Because institutions do not operate on emotion. They operate on position. First, they position themselves. Then, they tell the public where the market is going. Then, they profit when the public follows their advice. This is not illegal. This is not even unusual. This is simply how institutional capital operates. And the $309 price target, regardless of whether it materializes, served a critical strategic function. It changed the conversation. Before this report, saying silver could reach $300 would have been dismissed as fantasy. After this report, it became a legitimate institutional forecast. The Overton window shifted. What was once considered impossible became merely unlikely. What was unlikely became possible. What was possible became expected. And expectations, in financial markets, become self-fulfilling prophecies. When major institutions believe silver will rise, they allocate capital toward it. When capital flows increase, prices rise. When prices rise, more institutions take notice. The cycle reinforces itself. Bank of America's report was not just analysis, it was permission. Permission for conservative pension funds, for risk-averse family offices, for institutional allocators who need credible cover before making commodity investments. To finally enter the silver market. And that permission is worth far more than any single day's price movement. Markets, unlike humans, never forget. Every price level, every rejection, every failed breakout becomes etched into the collective memory of millions of traders worldwide. These memories manifest as invisible lines on charts, lines that determine where buyers step in and where sellers defend. January 7th revealed something that technical analysts had been quietly watching for over a week. Silver was testing a ceiling, and the ceiling was fighting back. December 29th, during the thin trading of Ghost Week, silver had surged violently upward. Momentum players, algorithm-driven funds, and enthusiastic retail traders pushed the price to $83.71. For approximately 40 minutes, it held above $83. Then, without warning, without news, without any fundamental catalyst, the price collapsed. Not a gentle decline, not a slow retreat, a vertical drop that erased hours of gains in minutes. Traders who bought above $83 were trapped. Stop-loss orders triggered in cascades. The psychological damage was severe. Fast forward to January 7th. 9 days later, silver once again approached that same level, climbing steadily through the morning, fueled by Bank of America headline euphoria. It reached $82.75, just 96 cents below the previous high. Close enough to trigger memories, close enough to activate defensive positions, but not close enough to break through. And then the exact same pattern repeated. The price stopped climbing, hesitated, and collapsed. In technical analysis, this formation has a name, a double top. Two peaks, approximately equal height, separated by time, both rejected at the same resistance zone. The pattern resembles the letter M when drawn on a chart, and it carries a specific implication: exhaustion. It suggests that buyers lack the strength to push higher, that sellers are defending a specific price level with tremendous conviction, that supply overwhelms demand at this altitude. Traditional technical analysis textbooks state that a double top pattern, once confirmed, typically leads to a decline back to what is called the neckline. The neckline, in this case, sits near $70, $8 below current prices, a potential 10% correction. This is why panic spread through social media on January 7th. Technical traders were sharing charts, highlighting the M formation, warning that $70 was the next destination. But here's where market theory diverges from market reality. Textbook patterns assume normal market conditions. They assume balanced supply and demand dynamics. They assume rational participants operating without external pressure. They do not account for structural shortages, They do not account for central bank monetary policy. They do not account for physical commodity markets where actual metal must be delivered. Silver in 2026 operates under conditions that technical patterns were never designed to analyze. There is a documented supply deficit. Industrial demand exceeds mining production. Solar panel manufacturers are consuming record quantities. Physical premiums above paper prices remain elevated, and yet the price was rejected twice at $83. This creates a paradox that separates experienced analysts from novice traders. The fundamentals say shortage. The technicals say resistance. Which signal is correct? The answer lies in understanding what the double top actually represents. It is not necessarily a reversal pattern signaling lower prices ahead. It is a transfer pattern, signaling that ownership is changing hands. At $83, there are sellers, large sellers, institutional sellers, sellers with millions of ounces to distribute. They are not selling because they believe silver is worthless. They are selling because they accumulated lower, and 83 represents their profit target. But below them, at lower price levels, there are buyers, different buyers, strategic buyers, buyers willing to absorb the supply that sellers are distributing. These buyers do not chase prices, they wait. They allow emotional traders to push prices up, then they allow profit takers to push prices down, and they quietly accumulate in the middle. The evidence for this accumulation appeared in the volume data. On January 7th, as the price fell from 80.275 to 78.54, volume spiked significantly. High volume during a decline typically indicates panic selling, but the price behavior told a different story. Every time silver dipped below 78.50, it bounced immediately, not slowly, not gradually, but with sharp reversals that suggested aggressive buying. Someone, or multiple large entities, were placing massive buy orders at $78. They were defending that level, absorbing the selling pressure, preventing further decline. This is not panic, this is accumulation. Weak hands selling to strong hands, retail distribution to institutional accumulation, short-term traders exiting to long-term holders entering. Now, the relationship with gold becomes critical for understanding silver's technical structure. Gold on January 7th declined $32 from $4,485 down to $4,453, a decline of approximately 0.7%. Silver declined 3%, more than 4 times gold's percentage drop. This ratio behavior is called beta. Silver's price movements are amplified versions of gold's movements. On the way up, silver rises faster than gold. On the way down, silver falls faster than gold. This is not a flaw. This is structural characteristic of the gold-silver relationship. But notice something critical. Gold did not break its uptrend. It did not violate support. It simply pulled back slightly from all-time highs. Gold remained in a bull market. And here is the iron law of precious metals markets. Silver cannot enter a sustained bear market while gold remains in a bull market. The correlation is too strong, the relationship too established, the market structure too interconnected. If gold is making higher highs, silver will eventually follow. The lag time may be days, weeks, or months, but the direction remains linked. So the January 7th decline in silver, while painful for those who bought at $82, was not a trend reversal. It was a volatility event within an ongoing uptrend. The technical indicator called RSI. Relative Strength Index confirmed this interpretation. The day before the crash, RSI on the daily chart had reached 80. Anything above 70 is considered overbought. 80 represents extreme overbought conditions, unsustainable momentum, an engine running too hot. Markets cannot maintain 80 RSI indefinitely. Corrections are not optional. They are mechanical requirements. By the close of January 7th, RSI had reset to the mid-60s, still positive, still indicating upward momentum, but no longer extreme. The market had released pressure without breaking structure. This is healthy price action, not destructive price action. Now, the critical question facing every trader, every investor, every business strategist watching this market, where's the line that cannot be broken? Where does consolidation become reversal? Where does healthy pullback become structural failure? 2 levels matter above all others. $78, the immediate support, the breakout level from earlier in the week. Holding above 78 means the bull market is exceptionally strong, that buyers are defending aggressively, that the trend remains intact without even testing deeper support. $75, the major support, the ceiling that capped prices throughout December. There is an old trading principle. Previous resistance becomes new support. 75 was the level silver could not break above for weeks. Now that it has broken above, 75 should act as a floor. Below 75, the breakout fails, the technical structure breaks, and a deeper correction toward 70 or even 65 becomes probable. But as of the close on January 7th, silver sat at 78.54. more than $3 above the critical 75 level, a substantial buffer, a margin of safety, a cushion that allows for further volatility without structural damage. The chart was ugly, the daily candle was red, the double top was visible, but the foundation remained intact. There's a moment in every market correction when clarity emerges from confusion, when the noise separates from the signal, when strategic thinkers distinguish themselves from reactive participants. January 7th, as the clock moved toward the closing bell, presented exactly such a moment. Across trading platforms worldwide, portfolios displayed red numbers, social media filled with frustration, anger, accusations of manipulation. Novice investors stared at screens wondering whether to sell and cut losses or hold and hope for recovery. But professional capital, institutional allocators, family offices managing generational wealth, they were asking a completely different question. Not whether to panic, but whether the fundamental thesis had changed. And this question, this single analytical framework, separates wealth preservation from wealth destruction. Consider what actually changed on January 7th. Did solar panel manufacturers suddenly discover an alternative to silver's conductivity properties? No. Did new silver mines magically appear and solve the structural supply deficit? No. Did global debt levels decline, making precious metals less relevant as monetary hedges? No. Did central banks reverse course on monetary expansion policies? No. Did the physical shortage disappear overnight? No. Then what changed? Only one thing changed. Sentiment. The emotional state of short-term traders, the confidence level of those trading with leverage, the patience threshold of those who entered positions without conviction. Sentiment is temporary. Fundamentals are structural. Sentiment fluctuates daily. Fundamentals evolve over years. Sentiment creates price volatility. Fundamentals determine price destination. And understanding this distinction is worth more than any technical indicator, any chart pattern, any headline-driven trading strategy. Bank of America's $309 forecast did not become invalid at 10:43 a.m. when the price peaked. It remained exactly as valid, or invalid, as it was when published. The mathematical case for $300 silver rests on verifiable data points. Annual supply deficit of approximately 200 million ounces. Solar panel production requiring 700 million ounces by 2030. Industrial applications consuming 60% of total supply. Investment demand competing for the remaining supply. Above-ground inventory declining year over year. These numbers did not change when the price dropped 3%. The roadmap to $300, if it exists at all, was never going to be a straight line. Markets do not accommodate convenience. They do not move in smooth, predictable arcs. They oscillate, they whipsaw, they shake out weak participants before major moves. This is not a flaw in markets. This is the purpose of markets: to transfer assets from those with weak conviction to those with strong conviction, from those operating on emotion to those operating on analysis, from those with short time horizons to those with strategic patience. And January 7th was a textbook example of this transfer mechanism in action. Now, for those managing capital, whether personal savings or institutional funds, the next 48 hours carried significance beyond the daily price movement. Professional traders understand something that novice investors often miss. The daily close matters less than the weekly close. Intraday volatility, the spike to 82, the crash to 78, is noise. What matters is where the market settles when the week concludes. 2 days remained until Friday's close. Thursday and Friday trading sessions would determine the weekly candle formation, and the weekly candle would signal whether the current structure remains intact or has broken. The critical threshold, $75. If silver closes the week above 75, the weekly chart prints a candle with a long upper wick but a green body. This formation tells algorithms, tells institutional scanning systems, tells technical analysis programs that despite intraday volatility, despite emotional selling, despite the double top formation, the breakout level is holding. The trend remains up. Volatility is present but not destructive. However, if selling pressure intensifies through Thursday and Friday, if the price breaks below 75 and closes the week beneath that level, the weekly chart prints a failed breakout pattern. This signals to systematic traders, to trend-following algorithms, to risk management systems, that the move above 75 was premature, that sellers have regained control, that a deeper correction is likely. The difference between these two outcomes is not trivial. It determines whether sophisticated capital views this as a buying opportunity or a trend reversal, whether algorithms initiate long positions or trigger stop losses, whether the next wave of institutional money enters or remains on the sidelines. Given the physical market dynamics, given gold's continued strength near all-time highs, given the structural supply deficit, probability favors the bulls holding 75, but probability is not certainty. And this is why the next 48 hours required observation rather than reaction. For those who entered silver positions based on long-term fundamental thesis, based on belief in monetary debasement, structural shortage, industrial demand growth, the January 7th decline should not trigger panic. It should not even trigger reconsideration. A 3% single-day drop on the path to a 300% gain is statistical noise. It is the cost of admission to asymmetric opportunities. It is the volatility premium that allows patient capital to extract returns from impatient capital. The mathematics remains unchanged. If silver truly reaches $300 from current levels of 78, that represents a 285% gain. Yesterday's $2 decline represents 0.6% of that journey. Should 0.6% volatility cause abandonment of a 285% thesis? Strategic thinkers say no, emotional traders say yes, and this difference in response is precisely how wealth transfers occur. But for those holding cash, those who missed earlier entry points, those waiting for confirmation before committing capital, January 7th offered something valuable, a second chance. Markets rarely provide do-overs. They rarely allow those who missed breakouts to enter at nearly identical prices. But manufactured volatility occasionally creates exactly this opportunity. Silver broke above $70 weeks ago. Those who hesitated, who waited for more confirmation, who wanted to see sustained momentum, watched the price climb to 83 without participating. Now, through the mechanism of profit-taking disguised as news-driven selling, the market had returned to 78, $5 above the original breakout, but $15 below the recent high. For someone with capital and conviction, this represents asymmetric risk-reward, buying a breakout asset that is retesting support rather than chasing it at resistance. The risk is defined. A break below 75 invalidates the trade with minimal loss. The reward remains undefined. If the $300 thesis has any validity, the upside is multiples of current price. This is the type of setup that professional capital seeks. Not chasing parabolic moves, not buying headlines at peak euphoria, but entering during manufactured fear when weak hands are distributing to strong hands. Of course, the opposite scenario also presents itself, that 78 represents the beginning of a larger decline back to 70, to 65, to 60. That the double top is confirming a trend reversal rather than a consolidation. That Bank of America's report was the top, not the beginning. This scenario cannot be dismissed, but it requires believing that the fundamental drivers have reversed, that supply deficits have resolved, that industrial demand has peaked, that monetary conditions have normalized. In examining those variables objectively, none show signs of reversal. So the strategic positioning framework for the remainder of the week becomes clear. For existing holders with long-term conviction, do nothing. Allow the market to resolve the 75 level without interference. Avoid the temptation to trade around volatility that could easily reverse without warning. For those with capital-seeking entry, 75 to 78 represents the zone of opportunity. Not aggressively chasing, but patiently placing orders at levels where risk is defined and reward remains open-ended. For those trading with leverage, with short-time horizons, with capital they cannot afford to see decline, the honest answer is that commodity volatility may not align with their risk tolerance or time frame, because the path from 78 to 309, if it occurs at all, will not be smooth, will not be predictable, will not accommodate the need for steady returns. It will be violent. It will be chaotic. It will shake out anyone without conviction. And that volatility is not a bug. It is a feature. It is the mechanism that allows patient strategic capital to accumulate assets from impatient tactical capital. It is how wealth concentrates over time toward those who understand market structure rather than react to market emotion. January 7th was not the end of the silver story. It was a chapter, a violent chapter, but a chapter nonetheless. The institutions that distributed at 83 are now out. The retail traders who bought the headline are now trapped or capitulated, and the strategic capital that understands accumulation zones is now positioned. What comes next depends on whether 75 holds through Friday's close, whether gold continues its march toward 4,500, whether the physical shortage begins manifesting in delivery failures rather than just premium expansion. But for those who understand market mechanics, who separate signal from noise, who align time horizons with thesis, the January 7th crash was not a disaster. It was a discount. The question is not whether volatility will continue. The question is whether one's conviction can survive it. Because in the end, markets reward not those who are correct, but those who are correct and remain positioned long enough for the thesis to materialize. And that requires something more valuable than analysis. It requires patience.